Welcome aboard the Pilot Money Guys podcast, where our mission is to help professional pilots build and protect wealth on their journey to financial freedom. This podcast is brought to you by Leading Edge Financial Planning.
All right. Hello, Andy. Welcome again to Flight 129, Pilot Money Guys. We are excited you're here again today to talk about the second quarter or summary
First
of the
quarter.
I'm already getting ahead of myself. So we'll talk to that. We'll talk to some things going on in the markets that you may not have heard of yet. Even some things, Andy, that I was telling you was like, man, I'm not sure how this impacts us and our clients, and you're going to shed some light on that today. And we'll just continue our discussion on what's going on in Iran, the global markets.
Totally.
Lots of fun stuff today. So I'm excited.
Super fun. Yeah, you're not wrong, Charlie, for jumping to the second quarter. That's actually kind of appropriate because everything we wrote about, we talked about for the first quarter, basically is reversed at this point, and we're 2 weeks into the quarters. Which
I liked your news.
There.
Yeah, I liked your newsletter where you said you write down at the beginning of the quarter what you think. I don't know what you think might happen or what you think is important, and it's totally blown out of the water, there, so to speak.
Yeah, you try and write things like, oh, that would be interesting, and then you're like, that's you look at it on April 1st, and you're like, well, that's not. Yeah. That's not.
And these podcasts take a couple of weeks to come out, so we're talking about something that the world is changing so fast. But back to the basics, Andy. Our mission here, Pilot Money Guys, sponsored by Leading Edge Financial Planning. We want to deliver actionable ideas, simplify the complex. That's going to be your main job today. Cut through the financial noise to help you build a mindset for financial and life success. So today is going to be just an awareness, trying to provide some good information. It's hard to find good information right now, Andy. Every time I look at the news, what's going on in the world, I'm like, is this AI? Is this a meme? Is this true? And so I've really tried to focus on one source of trustworthy information lately, but there's bias in about everything, right?
Yeah.
So excellent.
No doubt.
Awesome. Hey, airline news. We got a couple things. You're predicting that United and American are going to merge, right?
Yes, totally. It's going to happen. That came out yesterday. I think it was Scott Kirby. He's the CEO of United. He pitched it to the president of the idea of a United and American merger, that would be interesting.
That would be. I'll say from the pilot perspective, disastrous. I don't know about economics, airline. Yes, the seniority. Can you imagine? So that would be probably not wonderful for anyone from the pilot perspective, but there's more to it. Andy, I just can't imagine. I mean, surely they were joking. I mean, I can't even imagine. You don't different administration, different Department of Justice, but you can't, Spirit can't merge with Frontier, but yet American and United can merge. I mean, come on.
Yeah, let's do it. It's interesting. The timing's not ironic, right? I mean, I think American, the balance sheet's probably the weekest. This energy, I don't know if you want to call it a crisis. I mean, it's kind of a crisis at this point, especially for airline stocks. The Journal has put out, they're already rationing in Europe and Asia. Yeah. And I think CEO Bastian of Delta is like, these are the times that we see distressed, and that's just true of any recession or any economic downturn, where companies that were sort of the walking dead, not that American is a walking dead, but you start to see distress, and that's where a lot of these consolidations start to take place. So maybe Kirby and United, they're projecting that out. If there was ever a time, this would sort of be it.
Man, I wonder if this is like when you were a kid, you ask your parent for something crazy outlandish, and then you're like, you didn't really want that, but you wanted something in the middle. And so maybe
all right, I'll take Spirit.
Exactly. So maybe there's something else going on there, but you're right. I mean, Trump even yesterday said himself, hey, these high fuel prices, in so many words, are pretty much going to persist through the year. Yeah. We know that. And that's going to be tough, already tough on the European airlines, going to be tough on the American airlines of the United States, I should say.
Yeah.
So.
Yeah, profit sharing next year. What's your prediction?
Same as before, zero. The other airline news, we talked last time, Spirit's called their pilots back, which is a big one. We're glad to hear that for the people that we know there. And looks like FedEx at least has a new tentative agreement out. TA is out with some good raises. I heard potentially that no more pension for the new pilots, possibly. We knew that was coming. I think they knew that was coming. And I don't know exactly who's grandfathered in there, but so that's some good news for our fellow airline
FedExers.
Pilots.
Long time coming.
Yes. So that's probably been tough there. So, all right. Best wishes to those folks. But we're also glad, Andy, Easter weekend, we were able to rescue one of our pilots there. That was an amazing story to follow through the Easter weekend where he was evading. And, man, that was, I'm crazy. Sitting there on the patio Saturday night. I was talking to my wife. I was like, there's a pilot right now in Iran running from the enemy, trying to get away. And, so it's amazing to think about what's going on while we're sipping our sweet tea on the back porch. You know what I mean?
Yeah.
It's incredible.
There's going to be a movie and it's going to be awesome.
Oh my gosh. I hope so.
Yeah.
And I hope he or she or whoever it was, and they get paid or whatever. I don't know. So, because it's
we'll get like the cameo, it's like Apollo 13. Jim Lovell was actually on the carrier deck, right?
Oh, I didn't know that.
Something like that. Yeah, fun fact.
Excellent. So that's a good story, and want to celebrate that. Answer to prayers there over the Easter weekend. So that was really good. But Andy, I think that's all I'm thinking about, man. A lot of stuff going on. By the time this comes out in a week and a half, there'll probably be some other stuff happening. But let's talk market stuff. You want to start off with just a general Iran war update and thoughts on that?
Yeah, we think Iran war. We put a video out. We did an email to our clients, and that was probably 5 or 6 weeks ago, and. As I was thinking about towards the end of the quarter, I'm like, really, what's changed at this point? And a lot, and also not a lot at the same time, which is pretty interesting. We've seen the markets react. Clearly, the markets are favorable towards the Strait of Hormuz reopening. What does that mean? That means the flow of oil and goods through that choke point can resume at what it was previously. That's 20% of the oil that actually flows through there. And Vanguard actually did a really good study, and I'll share it here for folks who are YouTubers. Essentially, they said, hey, look at the US, look at the Euro area, look at Japan, Asia. What does a prolonged conflict look like? And they predicted, 1 to 2 quarters, greater than 2 quarters. What strikes me, if you think about the US, and the fear here is, what is it going to do to our GDP, right? So essentially, how will this impact the economy? Because oil is not just gas prices, plastics, right? Manufacturing, those get impacted. Airline demand, jobs. And then, of course, what does that do to inflation, especially when it comes to energy prices? So clearly, if this is a prolonged conflict, we would expect GDP to likely go down. Whether that's going to be recessionary, we don't know, right? Time will tell. And inflation would likely go up. What's interesting is, Europe would be far greater impacted. Asia, they get a lot of their oil, frankly, from the Persian Gulf area. Unlike the U.S., we're a net exporter. So I think the upshot, and we talked about this, was it 2 podcasts ago, Charlie? We had Dr. Jim from Georgetown. Like these are global economies. Just because we're a net export of oil doesn't mean that we are insulated from oil shocks. So I think it still remains to be seen. Just today, as we're talking, I think the S&P 500 is, it was down 4.3% in the quarter, but now it's approaching all-time highs as it looks like peace talks may resume. They didn't go well last weekend. They may resume. So to me, Charlie, what do I think about is it's really hard, right? You don't want to get off a moving roller coaster right now.
Yeah.
We're a tweet away from the market shooting up or down, or Truth Social post. And we saw that, we saw that March 31st, it went up a 1% in like an hour. I mean, these are huge swings, relatively speaking, that like you're not going to catch it. Right. Yeah. If you think I know what's going to happen in the markets, like you just can't catch those in time and price those into your portfolio to take advantage of those things. And you need to be invested in those times to participate fully in the market. So we hope for a quick resolution. We'll see what happens in the markets. They're just a probability machine, Charlie. They're just they're trying to predict over exuberance versus this is going to destroy, oil price, or really $200 barrel. And we need somewhere in between.
Right.
And that's what that's what the market is sort of reflecting.
Yeah, absolutely. And things like you said, a tweet away or social media post away. So there's no predicting what's going on right now. We're talking about human beings. We're talking about events that are beyond anyone's control. So trying to make any kind of informed decision right now is impossible, quite frankly. And like you noted, the market moves tremendously, sometimes positively, right on the trail end of bad times in the market. And that's statistical. That happens over and over again. We could show statistics where you see these big, huge market jumps right at the tail end of something pretty nasty in the market. And you can't miss those. And that's statistical. We've seen that over and over again. Benjamin Graham, father of what, I don't know, we call him value investing, whatever the heck we call it.
Yeah.
So he said
the Warren Buffett teacher.
There you go. He said it, I don't know, 80 years ago. The market is, in the short term, a voting machine. It's human behavior. It's people voting irrationally, I think, in the short term. Mm-hmm. And then in the longer term, it's a weighing machine where it's based on company profits in the long term. Yeah. So we just got to hang on through some of this crazy noise in the short term.
Yep. I think that's exactly right. So I think that's kind of where we're at with Iran and oil. And again, we'll continue to watch it. It's interesting, Charlie, as I was thinking about this quarter up until the end of February, it was like, we're pretty just kind of bouncing around. We're pretty flat. And then this kind of happened, right? And so like I said, the quarter S&P 500 down 4.33% for the quarter. But I think what's interesting is that doesn't mean the U.S. market was down, and there were still some outperformers in the market from a U.S. perspective, and we can see that, right? So we know the S&P 500 that was down negative 4.33% for the quarter. But I like to look at where did we actually have positive returns? Small cap value last quarter was up about 5%, 4.96. Large cap value, 2%. And then you can see large cap growth, that was down almost 10% for the quarter. And those are sort of holding, when we look at the 1 year average, that small value up 28%, 15% for large value, and then large growth up about 18% over the trailing 1 year from quarter one end of 2026. So we just haven't seen that in the equity market in a long time. It's been growth has been the story for the last 10 plus years. S&P 500. We hear all the time, Charlie, why would I want to own anything other than the S&P 500, right? And I think this is a compelling story about there are reasons why you want to have diversity and diversification in your portfolio.
Andy, I think you're being way too calm about this point. I'm going to stand up at my table and jump around or something. We used to say foot stomper, in the training world, whatever. Yeah. This is amazing. I mean, it's like for 10 years-ish, and some of our investors, our younger investors, they've never seen anything but the S&P be the top dog. And and now, and you're right. I mean, there were people in 24 who were like, why are you guys investing in anything besides the S&P? And I mean, I was like, I don't, I feel pretty stupid. Yeah, I get it. But the data, you got to look at the data. You got to maintain discipline. And so last year it kind of started where S&P did great, but international did almost twice as good. This year, like you said, the S&P was down first quarter. But that doesn't mean the entire U.S. stock market was down. Those other categories were up. So finally, for those that were disciplined and patient, diversification is paying off and helping tremendously. The one thing I'll end my rant on there, Andy, is that I love to see these lessons where recency bias gets us a lot. And what we're seeing now as we maybe talk to new prospective clients or talk to other people, we see that right now, they're wholly invested in the S&P 500 index only.
Yeah.
And again, I get it because, man, that's been the top dog of the last several years. But right now, that's not looking so good. And I don't blame them. I'm not criticizing, but that's recency bias to the T messing with us a little bit going, hey, just invest in what did good, the last several years and you'll be fine. And that's not true. And that's the tough part about investing.
Yeah.
So. I'm done now.
Yeah. Good. It was a good foot stomp. I could hear it all the way over here in California.
I know it.
Yeah.
Absolutely.
No, it's so true. And even not just the S&P 500, but the Russell 3000, which is all 3000. Well, you kind of still track the S&P when you invest that way, just because it's market capitalization weighted in a portfolio. But yeah, maybe we'll turn. Let's look at international as well. I think that's a helpful thing to look at. We see the similar thing, not magnitudes, not quite as great. So in international developed markets, we see 3.99%. That's in local currency, and then 2.5 in US. Obviously, we have to convert those foreign dollars into US dollars in order to reap that benefit as a US investor. So that just means if we see a negative dispersion there, that the dollar had appreciated over the quarter. But growth down 3.2 in US dollar terms on the international side. And we can see that, again, 1 year, 32% for international developed, 13 market-wide, 23%. So again, back to that conversation of, hey, why would I want to own anything other than US? This is a good reason, right? So you can see international, and this held true even in the emerging market, right? Value outperformed growth by about 5-6%, up about 28% over the last year compared to, so you kind of compare that to like the S&P US market. And again, we're just seeing the benefits of diversification, and we want to be investors globally. And that kind of makes sense. Those valuations are a little less stretched. We've known that for a long time compared to US.
Yeah, absolutely. But the last few years, what we're seeing right now, even in US and international, like you just showed, for those of you that are listening to the podcast, go to the YouTube and check out the graphics that Andy just shared. But there were times, I can't remember, maybe 23, probably 21 and 23. 22 was a little off year, of course, but there were times we were like, wow, look at the difference look at the outperformance of growth and value. It really didn't even make sense. It was like, oh, this feels really unnatural.
Yeah.
You know what I mean? And now, again, we've got a lot going on in the global markets, but it almost makes sense to see that swing back the other way a little bit, because it wasn't natural then. It was just like you said, I think, an overshoot of the valuations and people getting a little bit too exuberant on some of these growth stocks that became overpriced, it seems like. And now that's coming back to a more fundamental value, or correcting back, maybe I should say.
And it kind of has to. I think, I can't remember the numbers, right? I would say, well, if Microsoft or Apple continues to grow at this pace, it'll be twice as large as the US economy, the global economy in 2 years. We're like, well, that probably can't happen. I don't know a lot about economics, but that doesn't seem, I don't think that can happen. And so at some point, like, the growth can't continue to grow. And it's like almost like value stocks become the growth stocks, right? Because those are the ones that are going to start to pierce through that hurdle into that growth territory. So that's where, like, hey, we want to own some of those stocks.
Yeah. And I'll just stress that, hey, we're not quote unquote value investors, although we're kind of hyping it today. We are diversified investors, and when growth and S&P, and especially growth, go on this tear, people start to lose their discipline when it comes to that diversification. And now it could hurt people a little bit during these times.
Yeah, don't chase it, right? So you're telling me, Charlie, is your 401k is not all 100% small value right now?
It is right now. I'm going to switch that out at just the right time, timing.
Yeah, that's it. Yeah, well, S&P 500's at all-time highs today, Charlie, at least session-wise. So now's the time.
Yes, absolutely.
Yeah. No, I think that's a great point. Like, you should still own the S&P 500.
Yeah,
right? Like,
absolutely.
Our clients still own the S&P 500. We haven't changed that just because it's gone down or hasn't gone up as much as value. Just like we own value and small cap for our client portfolios when the S&P 500 was doing great. So last quarter it was fun. Fun is an air quote here for our listeners. We were buying S&P 500 and we were buying the U.S. broad market. And again, that's just fun to see discipline play out.
Yeah.
Because now it's gone up, right? It was just from an implementation standpoint for our clients.
Yeah, absolutely. Because it's hard. I think the saying is, you're properly diversified when you want to throw up. And so, you sometimes, because there's something that's going to outperform you if you've got good diversification. And at this point, I don't really want to throw up. So that's kind of a nice feeling.
That's good. I'm happy for you.
Awesome. So let's see here. You can pick where we go next with this, but I saw that you have. What phase are we in? Is that is that a good next step?
Yeah, I just think it's there was FANG. I don't remember what was before FANG.
Oh yeah.
There's that was Facebook, Amazon, Netflix, Google.
Yeah.
There's the Magnificent Seven.
Mm-hmm.
What's the next one? Charlie, the other guys? I don't know.
What about the BRICS? Remember the BRICS?
Oh yeah, the BRICS.
Brasilia,
nice.
Brazil, Russia, India, China. Remember the BRICS? And was
South Africa.
South
Africa. That was our S. Yeah.
Yeah. It's hard to believe, right? That's kind of laughable now, but it's what happens.
Yeah. We had the BRICS. We had Mag 7. Yeah. So it's just like, what's next? Where are we going next? And there'll be a new moniker, a new name that we'll want to pile into. So it'll be fun to see what the market comes up with and the pundits come up with for our next thing as we go. But to me, this felt like right now, this kind of feels like the lost decade, right? We always talk about the lost decade. That's the 2000s. That was the S&P 500.
That's when I started investing. 1999.
Yeah.
That's me.
Nice.
I gave up on the S&P in 2005. I couldn't stand it anymore. I gave up.
Perfect timing. Yeah, that for that decade was down 9%. If you were in like a globally diversified portfolio, up 21%. Now that's total return. That's frankly not great over a 10-year period, but you still had positive returns over that time period. So we can call this the lost quarter, and we'll see what happens. Just because I'm tired of talking about the lost decade, that's 20 years ago, man.
Yeah, that's right. You were like 17 or something, I think.
Yeah, for sure. Can't do that.
Right? Close.
But we'll see. But I think fixed income, we'll touch on that a little bit. Just what's interesting to me there, one is inflation. I think that's going to be interesting to watch. And what does the Federal Reserve do with interest rates? We saw the print come in last week, 3.3% on headline CPI. And that intuitively makes sense because oil went from, 70, 80, maybe $60 a barrel, all the way over $100.
Yeah.
And that's translating into inflation. That's translating into higher costs. Yeah. So I think that'll be interesting to see. So we saw tips actually do fairly well because tips tend to do well when, unexpected inflation. We think about what's going to happen with the Federal Reserve and interest rates. The market really is just not even pricing in a rate cut for 2026. Yeah. So it's kind of like we'll probably be pretty static here because they've got a challenge, right? We just saw the Vanguard slide. GDP might be going down. That's not, so that would imply lowering rates, inflation going up. That would imply higher rates. So I don't envy the Federal Reserve right now with their rate predictions and trying to time that and trying to keep us out of a recession while not overheating the economy. This is probably one of the more challenging macroeconomic type environments from a policy perspective.
Andy, but yet on the other hand, my simple mindedness is like, how could the Fed possibly even consider cutting rates? Because everything that's happening is an inflationary. And if you cut rates, it just adds fuel to that overheating thing. Is it that simple?
I think it would be, Jerome Powell, Jay Powell, right? Yeah. He would say, you don't, oil shocks in general, you don't really chase it, if you will, from a policy perspective. It's just, you can't raise your way out of that one for kind of the same reasons, because that drag on the economy. So you kind of have to ride that out. We saw in February, 92,000 jobs were non-farm payroll jobs were lost. I think that's swung back up this year. I think there's some cracks in employment for sure. We're seeing that. And so I think that's where the kind of that dual mandate of the Federal Reserve is price stability and full-time employment or full employment. They've got to balance. They have to balance those things. I agree with you. I don't see a rate cut happening, but
what you said makes sense though, because I'm taking one thing in isolation. That's energy, and a lot of times, if I remember correctly, the Fed will look at CPI and exclude what energy, because it's so volatile. Like you said, they can't make long-term decisions based on that short-term volatility. So that makes sense. I didn't even think about that when I made my statement.
Yeah, and that's when you look headline CPI, that's the one that was up. Core CPI actually excludes energy, and the Fed actually uses PCE, so not even CPI, PCI, personal consumption expenditures, as their metric, I think, for their preferred metric for inflation.
Okay. So that helps me to understand it too, because I'm thinking, well, that would be crazy to lower rates now. But if you've got a faltering job market and an economy that's teetering on a recession, again, we're not close to that yet, but things could happen down the road. There's other parts of the world that probably are teetering on recession. And in fact, I read last night where what's going on, for the economies of the Middle East and around that area is worse than COVID because of the impacts. But Andy, I don't know if it's time yet or if you have anything to wrap that little segment up.
It's time.
But we've got a few minutes to talk about my favorite one, private credit.
Yes.
You wrote a good client quarterly update, and I was proofreading it to help and try to understand and make sure it was compliant, of course.
Yes.
And I was like, why are we talking about private credit?
Yeah.
You're going to tell us, because it's to me, it kind of flew under the radar, even as I try to keep up with things as well.
Yeah, I think it's two questions, right? Three. What is it? Do you want to own it? And then are the issues we're seeing with private credit redemptions and loans and really like defaults, are they going to filter into the broader economy? I think about what is private credit. As the name implies, it's private. So it's not like I can go buy Apple and Nvidia stock in the public market. That means I can buy it, I can sell it. It's super liquid. Private doesn't have that feature. So when we think of private, I think of illiquidity, which just means if I put my money in this investment, I can't go immediately and get it. And it's credit, right? So we hear about private equity a lot. That's you buy a stake in a company, you own a percentage. And then, the hope is it IPOs or you sell it to somebody else. But that's the idea of you kind of have unlimited upside. Credit is debt, right? So that's just, I'm going to give you a loan. I'm going to charge you a percent that's commensurate with the amount of risk that I'm taking, and you're going to pay me that loan back. So it's private and it's not liquid. There are some semi-liquid, like public business development companies that trade. But for the most part, it's illiquid and it's debt. And so that's, why do people like it? It offers higher returns. And anytime someone says it offers higher returns, you should just immediately replace returns with risk in your head, right? And I think that helps me frame the discussion, right? Someone says it has higher returns. I'm like, great, it's riskier. There's just no other way to make that math work. So I think that's kind of question one from like, do you want to own this from a private credit standpoint? I don't know. What do you think, Charlie?
Yeah, it's like Dr. Jim said a couple of podcasts ago. Well, you really need to understand why those are higher returns. Because you could quickly, those higher returns could quickly mean big time losses. That's what it looks like in my mind. And I think that's kind of what everybody's kind of worried about, right? And what's and
we saw some research. The S&P BDC index, which is a proxy for all of private credit, in the last year down a little over 13.5%. And so the concern here is, are these valued? Again, it's private. It's hard to value, right? Because I know what a share of Apple costs because it trades like this, super rapid on the market. It has a fair reflection of its value because of its liquidity. If I go and buy this private credit loan, I don't really know what that cost. I think I might know, but I don't really know. Same thing with private equity, because I don't have it's something is only as valuable as what someone else is willing to pay for it. And I don't have that constant check on the value of an asset. So that's kind of the first piece of like, what are these worth? And these redemptions we're seeing are probably a sign, like Blue Owl, which is a large private credit provider, had about a 22% redemption request. Typically you get about 5 5%. Now, just on the news today, we heard that PIMCO, I think, bought all of that. So there's a buyer out there. But people are trying to get out of these funds. And so the concern is maybe these things aren't worth as much as we initially thought they were, right? Yeah. And maybe these loans are going bad. We saw that with, there was an auto company, I think last fall, that went bankrupt. And are these concentrated in software companies too? I think about 15% of BDCs are in maybe software. Maybe it's more. I can't remember the number. But are they? What segment of the market that are being impacted by AI is this private credit in?
So maybe the implication there, like for me, I was like, yeah, private credit, people trying to, reach out for higher returns are probably going to get smashed at some point. But there could be other implications there. There could be implications that it ripples into the economy. And that's kind of what got my attention. I was reading a little bit more on it, is like we all may or may not be insulated from this, maybe the full implications. Is that a thing?
It could be. Yeah. We don't know. I think private credit has grown tremendously. Some of that, again, comes out of the global financial crisis regulations in 2010, Dodd-Frank, where banks were required to keep more reserves, so meant they have less lending capacity. And so companies who need capital are going to go and seek it where they otherwise can. And that was sort of the genesis of private credit. But the concern would be, right now, a lot of it's institutional accredited investors. There's some retail on private credit. The concern is, well, maybe these loans that are being made by banks to the business development company who is then lending to these private creditors. And so maybe the bank balance sheet, and really insurance is a lot of concern as well. Maybe these insurers' balance sheet is more exposed than we otherwise thought to these downturns in private credit. If these loans turn out to be pretty bad, is there a contagion effect in our banking system? And I think that's kind of the concern. Right now, I think bank loans account for maybe 15% to BDCs. If you think about where we were in the global financial crisis, bank loans were about 53% to mortgages. So that's a big difference. In other words,
can you explain that, Andy? I'm sorry to interrupt you there. But can you elaborate on those percentages? Because I'm not tracking that. The 15% versus the 50%.
Yeah. So in other words, essentially the if you think about a bank balance sheet or BDCs, like where are they getting their loans from? About 15% is coming from banks. So in other words, the other 85% is coming from other investors.
Got it. So the BDC is that's business development company,
business development,
mid-sized company, right?
That's right. Yeah.
Okay.
Yeah. That's right. So that's the concern, is like, how exposed are these banks or these insurance companies to private credit? I think right now the consensus is not too terribly. Questions are being asked, rightfully so, about how much, and that's happening at the Treasury. The U.S. Treasury Department's, I think, asking those questions of banks. So we're having the conversation now in the hopes that it doesn't become a bigger thing.
Got it. Okay, that makes a little bit more sense. I see. So it's that's partly why it's interesting to follow, and not just individual investors trying to get higher yield. That's right. That could ripple through a little bit, it seems like.
That's right. Yeah. If you look at where these private creditors are getting their money from, essentially 15% of it's coming from banks.
Got it.
As opposed to 53% in the global financial crisis for mortgages, which was a huge concern because obviously the subprime mortgages, those kind of blew up. That's what really created a lot of issues.
Yeah. It impacted everyone, like you said.
Yes. Yeah.
Excellent. What do you think, Andy? Any closing thoughts kind of to wrap it up today, as far as just any of the things we've talked about?
Yes. Send me what you think we'll write about for the next time.
Make your predictions.
If you're making predictions, if you're listening. No, I think this quarter in particular highlighted just be diversified. You want to own all of the market. That's international, that's value, small cap. But that, and don't chase, right? Just because we said small value is up, that those dispersions, that doesn't mean go all small value. It just means you want to have some of those things. You just never know where it's gonna where the market will kind of manifest itself at any one time.
Yeah. Last night I was reading about the new blockade that's going on in the Strait of Hormuz and the thought process behind there. And it seemed like to me, it's kind of a waiting game between, as the U.S. institutes their own blockade, that's going to negatively impact Iran, of course. I think that's the point. However, the Strait of Hormuz is still essentially closed, single-digit ships getting through there versus hundreds before this started. So it appears that it's almost like a game of cat and mouse on who cries uncle first, because the global market will be hurt, but Iran is also, again, that's the point, is to kind of squeeze them economically. So it's not going to go away anytime soon, I think, is maybe the point that I got out of that, is that it's going to be a little bit of a waiting game for the rest of the year to see how these negotiations go, see who comes to the tables. Everybody's getting hurt. China is probably one that's getting hurt quite a bit too. It's going to be interesting to see how they weigh in on that. But yeah, this is going to be one where, to me, Andy, times like these, I think I always go back to, what can I control? I can control my personal balance sheet, my personal spending, my savings, my own debt, and so those are things that I can control. I can kind of control my own inflation, Andy. I know that sounds maybe offensive to some folks that are struggling to get groceries, and I get it. But I can just spend less if I need to, and sometimes there may be a time to do that when the going gets tough. And I kind of think it will. I mean, I hate to be negative, but I think we're going to have to be patient on this one.
Totally. Yeah. Great thoughts.
Can we end on a better, happier note, or you got something else maybe funny to say?
Yeah. I don't know that I can. Yeah. Thanks, Charlie.
All right. Sorry about that. But that's the reality. It's a tough time. And so we hope good comes out of it. We believe that it will. And thanks, Andy, so much for all the good words today. It's always a huge learning lesson for me to look back. We don't use that to make immediate decision, but it helps us to maintain discipline. It helps us to reinforce what we already know sometimes. And I love looking back and learning from those moments. So thanks for doing that.
Yeah.
If you found our podcast helpful, please share it with someone that you think can benefit. Please like and subscribe. Give us some comments on wherever you get your podcast. We appreciate those comments. It helps us to reach more people on the podcast, and hopefully help people cut through the noise and get a good perspective, on what's going on. So please do that for us. We thank you for your, thank you for the pilot community for listening and sharing, and appreciate your feedback. We will see you next time. Hello, Pilot Podcast family. Charlie here. I just wanted to share with you something we've just recently developed. In the show notes, you're going to see the Pilot Wealth Index. We want you to check it out. Give it a shot. It's a quiz, a short questionnaire that allows you to understand, are you on track? We have a lot of people that say, hey, we just want to know if we're on track. Are we where we should be at this stage of our flying career, airline career, whatever it might be? How am I doing? Am I close to my peer group? Am I behind? Am I ahead? We've developed some questions, some metrics that we think if you go through this and check it out, answer the questions, you will have a very good idea of where you stand. We developed the questions that give an indication of, are you doing the right things you need to do to be prepared for an eventual retirement, and that one that can be profitable for you. So check it out in the show notes, the Leading Edge Pilot Wealth Index. We hope you give it a shot. If you have any questions at all, reach out. Happy to help. Charlie at leadingedgeplanning.com. Again, that's Charlie at leadingedgeplanning.com. You can call or text me on my cell, 865-328-4969. Thank you very much.
Thank you for listening to the Pilot Money Guys podcast. Please subscribe, rate, and review on iTunes or wherever you listen. We are grateful for your reviews because they encourage others to listen in. Visit leadingedgeplanning.com to learn more and subscribe to our newsletter. Leading Edge Financial Planning, LLC, LEFP, is a registered investment advisor. Advisory services are only offered to clients or prospective clients where LEFP and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.leadingedgeplanning.com. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. The views expressed in this commentary are subject to change based on market and other conditions. These documents may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. All information has been obtained from sources believed to be reliable, but its accuracy is not guaranteed. There is no representation or warranty as to the current accuracy, reliability, or completeness of, nor liability for, decisions based on such information, and it should not be relied on as such.